is a powerful story often told in finance. It usually begins in a conference room during the autumn of 2008. Phones ringing, liquidity evaporating, institutions trembling, markets freezing. And the message that follows is always the same. The system nearly collapsed once, therefore it can collapse again at any time, and you must structure your portfolio as if catastrophe is permanently imminent. It is an emotionally compelling narrative. But it is not a sufficient investment framework. Yes, September 2008 was real. Yes, systemic fragility exists in leveraged financial architectures. And yes, markets periodically experience episodes of correlation spikes and liquidity contraction. However, transforming a once-in-a-generation liquidity seizure into a permanent baseline assumption for retail portfolio construction is not risk management. It is fear-anchored asset allocation. Professional investors do not build portfolios around trauma. They build them around probability distributions. The distinction matters. Markets are not machines designed to collapse without warning. They are adaptive pricing systems responding to liquidity conditions, monetary policy regimes, productivity expectations, and capital flow dynamics. When we treat every future cycle as a replay of 2008, we are no longer analyzing markets. We are reacting to memory. And memory is not strategy. The claim that systemic breakdown is mathematically certain on a predictable cycle misunderstands how financial crises actually occur. Crises are not mechanical clockwork events. They are regime-dependent phenomena shaped by leverage concentration, policy mistakes, and structural imbalances that accumulate over time, not inevitabilities scheduled on a hidden timer. Investors who structure their entire portfolios around worst-case scenarios often sacrifice the very mechanism that builds wealth in the first place, compounding participation in growth assets. There is a difference between preparing for storms and living permanently underground. Another common assertion is that traditional diversification fails exactly when investors need it most. This argument sounds persuasive because correlations do rise during liquidity events. But correlation spikes are temporary features of stress periods, not permanent properties of markets. Over long horizons, diversification remains one of the most statistically reliable tools available to investors. Equities, bonds, real assets, and commodities do not behave identically across economic cycles. Inflation regimes, tightening cycles, credit expansions, and productivity booms create differentiated performance environments. Suggesting diversification becomes meaningless during crises ignores the far larger reality that investors spend the overwhelming majority of their investing lives outside crisis conditions. Portfolio construction must reflect the full timeline, not just the worst weeks inside it. Another assumption embedded in the crisis-first narrative is that investors are consistently blindsided by downturns. In reality, most drawdowns occur alongside visible tightening financial conditions, deteriorating credit spreads, or valuation compression signals that unfold gradually rather than instantly. Markets rarely collapse without warning signals. The deeper issue is psychological framing. When investors are taught to believe that financial systems are constantly on the edge of freezing, they begin optimizing portfolios for survival instead of durability. Survival strategies often prioritize protection over participation, insurance over exposure, and caution over compounding. That trade-off is not free. Protection always has a cost. And that cost accumulates invisibly over decades in the form of opportunity loss. Institutional portfolio managers understand something critical that retail investors are rarely told clearly. The objective is not to eliminate risk. The objective is to price risk efficiently relative to expected return. A portfolio designed primarily to avoid drawdowns can quietly become a portfolio that avoids growth. This is where the conversation about structural protection tools begins. But before accepting them as solutions, investors must first ask a more important question. Are they solving a real probability problem or responding to a narrative shaped by one extraordinary moment in financial history? Because the answer to that question determines whether protection becomes a strategic advantage or a long-term performance drag disguised as discipline. One of the most persuasive ideas in modern retail investing is the concept of the permanent portfolio shield. The argument sounds logical on the surface. If markets crash unexpectedly and diversification temporarily weakens, then the solution must be structural downside protection built directly into the portfolio itself. This is where protective put strategies and so-called defensive ETFs enter the conversation. They are often presented as institutional tools repackaged for individual investors. They promise stability during crises. They promise emotional clarity during volatility. And perhaps most importantly, they promise a defined floor under your wealth. But the presence of a floor does not automatically mean the structure above it is efficient. To understand why, we need to examine what investors are actually buying when they purchase systematic downside protection. They are buying insurance, and insurance, by definition, is not designed to create wealth. It is designed to transfer risk at a cost. Protective put strategies work by continuously purchasing options that gain value when markets fall sharply. The mechanics are straightforward. If the market declines below a predefined threshold, those options offset a portion of the losses in the underlying portfolio. In theory, this creates stability. In practice, however, stability is never free. The cost appears as option premiums, roll costs, volatility pricing distortions, and structural performance drag during normal market conditions, which represent the majority of market environments investors actually experience. This is the part most marketing explanations leave out. Systematic protection strategies must be renewed repeatedly. Options expire, protection resets, premiums accumulate. And over long horizons, these recurring costs compound against the investor rather than for them. The result is not catastrophic underperformance, but it is persistent underperformance. Institutional investors understand this trade-off clearly. That is why protective put overlays are typically deployed tactically, not permanently, and usually only during periods when volatility pricing is unusually favorable relative to perceived downside risk. They are tools, not foundations. Another common claim is that protective ETFs replicate the behavior of institutional risk management frameworks. That statement sounds convincing because institutions do use options. However, institutions do not rely on static protection structures in isolation. They adjust exposure dynamically. They hedge selectively. They manage liquidity actively. And most importantly, they control leverage directly through balance sheet positioning rather than outsourcing protection entirely to packaged instruments. Retail investors using permanent hedge ETFs are not replicating institutional strategy. They are approximating one narrow component of it. There is also a deeper misunderstanding embedded in the idea of a guaranteed downside floor. A floor only protects against certain types of declines within certain ranges and over certain time horizons. Option-based protection does not eliminate loss. It reshapes loss distribution. That distinction is critical because investors often interpret protection as certainty when in reality it is conditional mitigation. Another overlooked factor is volatility pricing itself. Protective strategies become most expensive precisely when investors feel they need them most, during periods of heightened uncertainty. Purchasing insurance after risk becomes obvious is rarely efficient. Markets price fear quickly, and they price protection accordingly. This leads to a paradox inside defensive portfolio construction. Investors who permanently allocate capital to protective overlays are often paying for insurance continuously during calm markets in order to benefit occasionally during crises. That trade-off can make sense in short tactical windows. It becomes far more questionable as a permanent structural allocation. The deeper issue is not whether protection works. It does. The real question is whether it works efficiently enough to justify the opportunity cost across an entire investing lifetime. Because long-term portfolio success is not determined by how well investors survive the worst 6 months of market history. It is determined by how effectively they participate in the other 99% of market time. Protection has value, but participation builds wealth. And confusing those two roles is one of the most common structural mistakes investors make when constructing portfolios designed to last decades rather than headlines. One of the most compelling justifications for permanent downside protection strategies is not mathematical. It is psychological. Investors are often told that the primary benefit of structural protection is peace of mind. The argument goes like this. If losses feel twice as painful as gains feel rewarding, as behavioral economics consistently demonstrates, then investors should willingly accept lower returns in exchange for emotional stability during market stress. At first glance, this reasoning sounds responsible. But emotional comfort is not the same thing as portfolio optimization. Behavioral finance does show that investors dislike losses more than they enjoy gains. That finding is well documented. However, the conclusion many people draw from it, that portfolios should therefore be permanently structured around loss avoidance, is a misunderstanding of what behavioral discipline actually requires. Discipline does not mean eliminating volatility. Discipline means staying invested through it. Long-term wealth is not created by avoiding drawdowns entirely. It is created by remaining positioned to benefit from recoveries after drawdowns occur. Investors who restructure portfolios primarily to reduce discomfort often end up reducing exposure to the very assets responsible for long-term compounding. And compounding is not driven by stability. It is driven by participation. Another common claim is that investors without structural downside protection are more likely to panic during corrections. But panic selling is not caused by the absence of hedging instruments. It is caused by the absence of a clearly defined investment framework. Investors who understand their time horizon, their liquidity needs, and their acceptable drawdown range rarely abandon portfolios during volatility events. Investors without those structures often do, regardless of whether protection overlays exist. In other words, psychology is shaped more by preparation than by insurance. There is also an important difference between managing emotional reactions and redesigning an entire portfolio around avoiding those reactions. The first improves investor behavior. The second can quietly undermine long-term performance expectations. This distinction becomes especially important when discussing retirement timelines. Many investors are told that avoiding large losses near retirement is the most important objective in portfolio construction. That statement is partly true. Sequence of returns risk is real. Large drawdowns early in retirement can permanently affect withdrawal sustainability. But the solution to sequence risk is not necessarily permanent option-based protection. The solution is portfolio structure alignment. That alignment can include diversified income streams, duration-matched bond exposure, staged withdrawal planning, and flexible allocation frameworks that adjust gradually as retirement approaches. These tools address sequence risk directly without requiring investors to permanently sacrifice growth potential decades before they need protection. Fear-based allocation tends to arrive too early and remain too long. And over long horizons, that timing matters more than investors realize. Another argument often presented is that structural downside protection allows investors to take more risk elsewhere in their portfolios. In theory, this sounds reasonable. If one part of the portfolio is protected, another part can pursue higher growth opportunities. But in practice, most investors do not actually increase productive risk exposure after adding protective overlays. They simply reduce overall portfolio efficiency. Instead of creating balanced offensive and defensive allocation layers, they create overlapping caution structures that dilute expected returns without meaningfully improving resilience. Institutions avoid this mistake by separating capital into clearly defined functional roles. Core capital compounds. Tactical capital hedges. Liquidity capital stabilizes. Retail portfolios often merge these roles together, and when that happens, protection becomes substitution rather than enhancement. The most overlooked psychological reality in investing is not fear during crashes. It is regret during recoveries. Investors who exit markets too early or underparticipate during long expansions frequently experience a different form of behavioral stress, the realization that caution itself carried a cost. That realization rarely appears immediately. It emerges slowly over years as missed compounding accumulates invisibly. Losses are painful, but missed decades of growth are permanent. This is why institutional investors focus less on eliminating volatility and more on maintaining exposure consistency across cycles. Emotional stability matters, but structural participation matters more. Protection strategies can reduce discomfort. They cannot replace discipline. And discipline, not insulation, is what ultimately determines whether investors remain positioned to benefit when markets transition from contraction back into expansion. The idea of the so-called unbroken portfolio sounds reassuring. A shield for protection, an arsenal for growth, a liquidity reserve for opportunity. On paper, the structure appears balanced, disciplined, and emotionally sustainable. But the problem with simplified three-pillar frameworks is not that they are wrong. It is that they are incomplete. Institutional portfolios are not built around symbolic layers like shields and arsenals. They are built around probability, duration alignment, liquidity segmentation, and exposure calibration across macroeconomic regimes. These frameworks are not designed to survive a single crash. They are designed to survive decades of changing conditions. That difference matters more than most investors realize. The first pillar, the permanent protective ETF allocation, is presented as a non-negotiable foundation. Yet professional portfolio construction rarely treats options-based insurance as a permanent structural layer. Instead, protection is deployed tactically when volatility pricing becomes attractive relative to forward risk expectations. Permanent insurance is not discipline. It is a cost commitment. And like all recurring costs inside a portfolio, it compounds. The second pillar, the growth arsenal, suggests that once protection exists, investors are free to take calculated risk with confidence. But confidence created by hedging instruments is not the same as risk capacity created by diversified income streams, balanced duration exposure, and stable liquidity buffers. True risk capacity is structural. It is not psychological. Investors increase risk capacity by aligning asset exposure with time horizon, not by purchasing volatility overlays. When exposure matches timeline, volatility becomes manageable. When exposure conflicts with timeline, protection becomes expensive. The third pillar, the liquidity reserve, is perhaps the strongest element of the framework. Maintaining strategic liquidity has historically separated investors who merely survive market corrections from those who benefit from them. Liquidity creates optionality. Optionality creates opportunity. But even here, the framework simplifies a more sophisticated institutional principle. Liquidity is not only about holding cash. It is about maintaining access to deployable capital across multiple conditions, credit tightening cycles, equity drawdowns, rate shocks, and valuation resets. Cash is only one form of liquidity. Balance sheet flexibility is another. Income stability is another. Duration matching is another. Institutions manage liquidity dynamically rather than statically. Retail investors should think similarly. There is also a deeper assumption embedded inside the three-pillar structure that crashes are the primary threat investors must prepare for. In reality, the greater long-term threat is not collapse. It is misallocation. Most portfolios do not fail because markets fall once. They fail because exposure does not match objectives over time. Investors either become too defensive too early or too aggressive too late. Protection frameworks cannot solve this alignment problem, only architecture can. This is why the strongest portfolios are not built around single defensive instruments. They are built around layered diversification across asset classes, inflation environments, and interest rate regimes. Equity exposure compounds growth, fixed income stabilizes volatility, real assets hedge purchasing power erosion, liquidity preserves flexibility. Each component performs a role. Together they create resilience. Another important misconception is the idea that the investors who survived 2008 were simply those holding the most liquidity. Liquidity helped. But survival also depended on leverage discipline, balance sheet strength, regulatory positioning, and access to funding markets. Cash alone was not the shield, structure was, and that lesson applies just as directly to individual investors as it does to institutions. The goal of portfolio construction is not to eliminate drawdowns entirely. No serious investment framework promises that. The goal is to make sure drawdowns remain proportional to time horizon, income needs, and recovery capacity. When those three variables are aligned, volatility becomes tolerable. When they are not aligned, protection becomes expensive. This is the difference between defensive investing and resilient investing. Defensive investing attempts to avoid loss. Resilient investing prepares for cycles. Markets will correct again. Liquidity will tighten again. Correlations will rise again. None of these realities are new. They are recurring features of financial systems operating across decades of expansion and contraction. But the investors who succeed through those cycles are rarely the ones holding the most insurance. They are the ones holding the strongest structure. Because long-term wealth is not built by predicting storms. It is built by constructing portfolios that remain standing regardless of whether storms arrive early, late, or not at all. And that distinction between reacting to crisis narratives and designing resilient allocation systems is where real financial discipline begins.